She took your money cause you bought puts right at the bottom. The stock market is a thief. She is a gold digger. YouTube. What it do? It's Little Petty coming back at you guys with another stock market episode. Alright, so if you guys have been following the channel, you guys know that we're going to go through this options trading business plan, teach you guys how to turn a trading account into a business account. So before I get into this episode, make sure you guys like, share, comment, subscribe if you're new. And I'm about to get right into it. So without further ado, let's get into talking about how we are gonna, on this channel, we're gonna show you guys trades. We're gonna go through and show you guys and teach you guys how to basically turn a small account and make it into an option trading business. What do you mean by that? Well, I'm gonna tell you that in this video, but I want to basically share with you guys Little Petty's option trading business plan. So, with all businesses, you need a business plan. So that's what we did. So, let's get into it. Give you guys this lesson, and then we will go ahead and get into the account and everything to provide you with the education for this video. So, we start off with the objective. What is the objective? The objective is to grow a small trading account that will generate an income of $500 per week by trading options. The main strategy that will focus on is selling high probability out of the money stock market option credit spreads on blue chip companies and index funds for a profit. The strategy will not be limited to iron condors, covered puts, and other option trading strategies that primarily focus on focus on selling options for a premium with a defined risk. So that is basically the objective. The objective is to basically turn a small trading account and generate an income of $500 per week selling options. That is the objective. And then we're going to have certain strategies that we're going to focus on. So let's get into the terms and conditions. So the terms and conditions are: you cannot risk more than the given percent for each stage your account is in. Your risk must be defined in sequence with the charts per trade, basically. The account will be held in a Tastyworks brokerage account, and the initial investment will be no more than $2,000. All right, so the stages that the account is going to be: stage 1 is $100 to $500. Your max risk is 20% of the account. Stage 2 is when your account is at $500 to $1,000. Your max risk is 17% of the account. Stage 3, when your account is at $1,000 to $2,500, the max risk is 15% of your account. Now, why do we have this broken down like this? The reason why we have it broken down like this is so that you can limit your chances of not blowing up your account. So, like I said, my initial investment is going to be around $2,000. No more than $2,000. And the whole point is, when you have so if you have a $500 account and you risk 20% of your account, you can basically lose on 4 trades before your account is blown up. So that's the reason that you want to have your risk defined on setting up your business. So now let's look at stage 4, 5, and 6. Now stage 4 is 25 to 5K. Your max risk is 12%. Stage 5, when your account is at 5,000 to 10,000, your max risk is 10%. And really 10% is where you kind of want to be when you can even start your stage 1 and only do 10%. Because if you do that 10%, you would have like 10 trades. So boom, right there. And then also when you get to stage 6, max risk is 8% of the account. So now, what is a credit spread? A credit spread is when the contract that you sell. So when you sell a contract and then you buy a contract, this is the formula. So when the contract that you sell plus minus the contract that you bought equals the credit received / your max gain, and the strike width minus the credit received equals the cost and what your max loss will be. Now let's go ahead and get into the account, because I want to show you guys what is going on. So we funded this account on April 17th. We put $500 in. Now, before I get into, because you're probably like, well, Lil Petty, your account only has 56 of buying power. Yes, so that means my account is basically 90% maxed out. Now, I'm going to get into that, and I'm going to explain to you what's really going on here. So when you're setting up your business plan, this right here is basically to keep you in structure with how you are going to set up your account. So by me knowing that I'm already not following the terms and conditions according to how I have it set up, I have justified that, and I'm not going to sit here and explain it to you guys, but I am going to be putting in more money into the account. But I basically just want to show you guys how to outline and write out, like I said, when you're going to turn this account into a business account. So you want to have your business plan written out, and you want to follow your structure. So now, like I said, I invested the $500 into it, and we have put on 4 trades. So I'm going to go ahead and get into the trades real quick, and I'm going to show you the strategy for that I put on for each trade according with the chart. So I do need to pull the charts up real quick. Yeah, you guys got that real quick, but that's all right. So the first trade that we did put on was the banks. So we put on a trade for JP Morgan, and the credit that we received was 18 cents. And our max loss on this was, I think it was like $40. And we ended up selling the 92 and 91.5 put, and as you can see, they're actually in the money. So this trade is more than likely probably going to lose. And I'm going to go to the charts and show you guys what happened. Go ahead and pull up this chart. So JPM. Alright, so we bought this 2 days ago. And like I said, so when the stock was up trading in this range, we sold a 195 put. So let's go to the charts, or let's go to the option table. So we sold the 92, and then we bought this one. So what that did was give us a credit of 18 cents, because the width between the 90, the 92, and the 91 was 50 cents. And then what we paid was 36 cents, and then we collected the 18 cents. So how does that work basically? Basically, if you were to short a contract, what you're basically saying is that these contracts are going to go worthless, whichever one that you're going to end up selling. If you want to sell a call, you're saying that the stock is not going to go at higher than a certain price. If you sell a put, you're going to say that the price is not going to go below this certain time by this certain date. Now, like I said, I ended up selling this one, and then I bought this one to cover this, because it's a small account. We're selling credit spreads until we can actually start selling nakeds. So, but as you can see, my risk was it's a very small loss, and so it's a very small loss, and that's the reason why you want to put on smaller trades when you're first starting on the account. Now, to turn it up a notch, we went ahead and sold another Wells Fargo the same day, and we ended up using about $60 of our buying power. So those two trades were justified. Those two trades were justified as, okay, we put the $500 in, boom. So the max risk was 20%, so that's about $60. So you can throw out $60 and the credit that we were going to receive, and these still have a chance to win. It's just a matter of if they get up to that certain price and expire by Friday. So we're gonna hold on to these. And the reason when you sell credit spreads, you want to actually put on trades that you're willing to lose. So for instance, if you was to come out over here and if we were to sell this and buy this, it's going to give you a 54% probability of profit. Your credit received is going to be 39 cents. And where do you get that from? You're selling this 260 and you're buying this. So the difference between these, but you also got to take into consideration it's the spread. So it's 267 minus 228, and that is going to give you a credit of 39 cents, which equals $39. And you're going to pay the with minus the credit received equals your cost or max loss. So that is how credit spreads work. Now, if you do it the opposite way, say you're going to short a call, you're going to sell the 90 and then you're going to buy this protection as a protection. Because say if you were to sell this naked, the buying power that you're going to need. No, if you're going to sell a call, so there's a difference between selling calls and selling puts. If you're to sell a call, the stock can go to infinity. So your max loss is really infinite. But the buying power that you would need is $1,000 to receive that $2.50 credit. But you can go ahead and buy this as protection, or you can move it out farther if you want to improve your profit range. But what we're doing, we're basically trying to take small profits and take small gains and build up the account slowly. But as you guys are gonna figure out, there's gonna be times where you're gonna want to take a little bit more risk in certain situations, but you have to be okay with knowing, I might possibly lose on this trade. Now, if you're not comfortable with losing the money, then I wouldn't put on the trade. So that is the whole reason in the options business, when you're making this a business, you need to stay focused on your risk, because without managing your risk, your account is going to get blown up. You're going to start trading credit spreads every other day, and next thing you know, your account is always going to be maxed out and you're always going to be looking for the next trade. So you want to statistically really look for good trades and set up and take good trades. So let's go ahead and get back into the chart and break down some of these outlooks that we have really quick. So like I said, the reason I sold this credit spread, I see a little pattern of a bullish uptrend. So I went ahead and took on a small risk, like I said, like $40 and I think it was like $30, because we're down $15 on this one, and then we're down $24 on this one. And this Nvidia is actually up, because this one's actually out of the money. One of these are out of the money. So if Nvidia breaks above 287, we'll receive the credit for, I think, $100. Now, the Netflix trade, this is the trade that was actually the best setup, but at the same time, it was a high risk because of the amount of money that I put into it. But the reason I wanted to put on the trade is because, for one, the earnings report, and this was like a good chance to actually put some money into the account. So I went ahead and took the risk, knowing that, I might lose $200, and the account would probably be, like I said, it'll be back at $56. So I'd already be down $500 on the account if all these plays went to nothing. And then we would only be able to put $1,500 into the account to finish off growing the account. But so I did go ahead and take the small risk. As you can see, the cash balance right now is at $956. So if all these plays hit, we would actually have already doubled the account. And that's kind of just getting some cushion for the account. But at the end of the day, risk management is the biggest thing when you're going to go ahead and start taking these types of trades. Now let's go ahead and get back into this, because I want to break down what we are going to be trading around the horn, selling options. So the best time to sell these credit spreads are going to be around earnings, but your earnings is gonna be chances where you can actually lose a lot, because if you're on the wrong side of the trade, then you're gonna get a pie on your face. Now, also, we like to look for implied volatility above 80. The reason of that is because, say we come over here and let's look at SPY contracts right now. So when the implied volatility is under, this is at 40. If we wanted to sell some puts, so let's say we wanted to sell the 272 and the 271 with 5 days. That's not a bad trade. It's gonna be a max risk of $78 to receive a credit of 22. But when there's stocks that have higher IV, for instance, let's look at, well, Netflix just had an IV crush, but let's go to like Roku. Yeah, so okay, right here, Roku has 100% IV. So if we were to sell these 118s and collect the 119s, you can see, boom. So this is a 67% chance of Roku not going below 118 in 2 days. So let's go ahead and look at Roku chart real quick, because I actually kind of like that setup. Yes, so Roku, okay. Let's see if we can possibly get like a 115. Let's see what those 115s are going for. And you gotta understand, this is real small time frames. But if we were to come and look at, let's say, the 9 days, you're gonna get a lot more premium. So if you were to sell even these 110s and these 109s, you would be able to collect. No, that's not really a good trade. Right here. So the 112s and the 111s, you'll be able to collect 33 cents of premium. You can even move this one out down to see if what you get more. So you could pay $138, 72% probability, and you will collect a credit of $62. So I kind of like that trade. You know, so, and Netflix needs to stay above this 112 for the next few days until next Friday, and then you got to understand the IV will come down and these contracts will get cheaper. So let's go ahead and look. So, for instance, now the Netflix play. Netflix reported earnings. Let's pull up the chart real quick. Netflix reported earnings. This was Netflix stock yesterday. So Netflix was trading around 447, came down to 425. And what we did, because we knew the earnings was going to come out, and if you look at the daily chart, Netflix has kind of made an all-time high. So to not be biased, we kind of had a feeling that Netflix might not get above this high, but it's probably gonna come down. But what we did was we basically sold an iron condor. So the play was let's go to Netflix real quick. We came over here. The IV was high, because if you actually look at the net changes, so these contracts yesterday were trading for about $19, and they went all the way down to $1.50. And these contracts were trading for about $10, $15, and they came down. Why does that happen? So when earnings come out, there's the stock, the options, the premium, they go up, because basically the market makers are expecting a big move. So when a big move comes, they jack the premiums up, so they make it harder for traders that want to buy nakeds make money. So the way that you take advantage of that is that you go ahead and you sell premium. You can take iron condors. An iron condor is a trade basically saying a stock's going to stay in this certain range. And if these contracts expire worthless and these contracts expire worthless, then I'm going to collect the whole premium that I ended up selling. So what was the play? We sold the 407.5 and we bought the 405. and then we sold the 445 and bought the 450, and we collected a premium of $300. And what was our risk? Our risk was, it was about $200. So we put on $200 to collect $300, and that's why I felt like it was justifiable to take the trade. So that's what we did. And Netflix, if you look, let's go back to the Netflix chart. If you guys look, the stock stayed in a range, and our profit range, as long as Netflix doesn't come below this, and as long as Netflix doesn't get above 445 by tomorrow, because I'm gonna sell out these contracts, then I have one on the trade. And that's the beauty of selling premium and taking advantage of volatility moves. So if you come back into trading around the horn, so we got the earnings IV crush. We like to look at things when IV is above 80. Short-term contracts, weeklies. So we're gonna go ahead and we're gonna trade those, but we're not gonna make that our biggest trades unless the opportunity presents itself. So we're gonna do short-term contracts, weeklies. We're gonna be the casino, because a bunch of people, and our favorite ones are gonna be Netflix, Tesla, Amazon, and all the big companies. So for instance, right here, let's go to the 9 days. So let's look at Tesla first. Let's look at the chart. Tesla. Let's go to the daily. All right, so the daily on Tesla and earnings is coming out on 4/29. So this might be actually a good opportunity. Yeah, so Tesla reports earnings on 4/29. So these contracts are actually going to be inflated. Yeah, so 4/29. And the stock price right now is at 732. Now there's a gap down here below at 650. So I would say, and you can see Tesla is on a bullish move right now. It is pulling back, but I would expect it. I would like to see it hold the gap. I'm not expecting nothing, because the stock can go either way. But to play this a neutral way would be to set up an iron condor. You could sell an iron condor. So let's say you wanted to sell the 810, 820, and then you wanted to sell the 660 and 650. This trade would be an expensive trade, $600, but the probability is a 75% to collect the $300. Now, I think a trade that I kind of like is selling a 650. So let's say we sold the 650 and bought this, because this width is actually not that big. So right here, you can basically collect $75, saying that Tesla will not come down below this. And you can also collect the money. You can collect part of the premium early. So look, let me show you real quick. So like if I wanted to close out this Netflix trade right now, I would get a credit of $437, and I would leave $63 on the table. So you can wait for the contracts to expire, but if the stock blows past any of these prices, then you'll end up losing some of your money back. So you kind of want to close out at like 75% of your profit. So like I said, I'm more than likely going to close this trade out tomorrow, get my money back, and then look for the next trade. And I kind of like the Roku. And this is just going off the fly. So if we were to sell, let's see what these 106s and 105s will give us. Yeah, so even right here, this is an 80% probability. You can collect $30 for $71. It's saying that Roku will not drop past below 106 by next Friday. And that, my friends, is basically how you set up trading options as a business. Now, why do I say, oh, I'm trading it, we're making a business out of this? Because 90% of options expire worthless. So when you are a trader and you are buying options that are out of the money, your probability, so let's just look, your probability of buying a 134 call is a 17% chance of you making money. Now, let's not forget stocks do have runs, but at the end of the day, this is what Wall Street does. They sell you the contracts. So that's what we're going to do. We're going to sell the trader contracts, but we're going to do it at a less riskier and a smaller pace because anybody can set this up. Anybody that has the knowledge and understanding of trading options and what options do and how they work, you can be the bank. So that's basically how we are going to be setting up our trades. We are going to be looking for probability of profit above 70, and then we're also going to be looking for 30 to 60 days to sell contracts when profit is around 70%. So that's basically how to set up a business options trading account, and this is to grow a small account and generate a weekly income of $500 per week. Now, to be clear on this, we're not expecting for this to work every single week, because I just turned the account possibly into $900. That doesn't mean next week I'm gonna go and put in another 900. And no, that's not how it works. We are taking advantage of these earnings, and we're going to be looking for certain trade setups. So that's basically, you need to understand the difference. You're not just, oh, we're going to sell Roku, we're going to sell Tesla, and we're going to do all this in one week, you know. So, but yeah, that's the video. I wanted to make this video, and I'm going to go ahead and give you guys updates on the trades. I'm going to make a video tomorrow after I end up selling out of the Netflix. We're going to close the Netflix out tomorrow. Hopefully the stock market does get one more nice little pop so we can get out of this Nvidia for a small profit. And if the banks don't go up, then we're taking a small loss. And that, my friends, is Little Petty's options trading business plan. Alright, I hope you guys liked the video. Make sure you guys like, share, comment, and subscribe. And I'm out, bro.